I'm Victoria Henderson, the host of Listen Up Homebuyers, and I read a headline, and the first thing I thought was I need to call Ramez Fahmy with Caliber Home Loans and get some answers to my questions. So, Ramez, first of all, thank you for coming on Listen Up Homebuyers. I really appreciate it.
Oh, it's my pleasure as always.
Yeah, I quick notice because I read it this morning and I immediately got in touch with you. And the headline read, Mortgage Giants Raise Loan Limits to a Record Level for 2023. It was a CNN headline. So I need you to walk me through this. And in the article, they mention a couple of things, and I'm just going to kind of put it out there. You give me some answers if you don't mind. Who are Freddie Mac and Fannie Mae?
So Fannie Mae and Freddie Mac are better known as the Federal National Mortgage Association and then the Federal Home Loans Mortgage Corporation. Those are the kind of the acronyms and then the nicknames that kind of come along with them. But they are basically the largest purchaser of mortgages in the country, right? And they are basically kind of like a quasi-government institution. They are kind of managed through the federal home loan mortgage sort of association. And they, like I said, they purchase mortgages. They're the largest purchaser of mortgages in the country. Your other options are basically kind of FHA and VA, and those are sort of managed by HUD. And then there's your private investors out there, which are kind of portfolio banks, credit unions, those sort of things.
Okay.
And lenders that, are servicing loan, that are purchasing loans outside of the main agencies. But I would say probably 80% of loans out there today, maybe higher, are going through Fannie and Freddie. Yeah.
Okay. So, so break this down for me. What is a conforming loan?
Okay. So a conforming loan is a loan that is being sold to one of these two agencies, or a conventional loan. They will start off with a minimum down payment of, say, a 3% down payment. And then, anything above that, some of your sort of specialty programs like Fannie Mae and Freddie Mac have what are called Home Ready and Home Possible. Those are sort of their programs that are geared a little bit more towards your sort of low to moderate income borrower.
Mm-hmm.
Fannie and Freddie in the past year have really kind of changed what type of loan it is that they want. They are wanting less to cater to sort of your high-end buyer who's thinking about buying second homes or your kind of much higher balance type loans, and really trying to concentrate their efforts on sort of your low to moderate and income borrower.
Okay, so why do you think they're doing that? I mean,
why? Because I believe that their charter, that they have with the federal government is really kind of geared towards that. And I think they're kind of getting back to those kind of roots that they had initially. One of the big things that they did earlier in the year was they added these what are called loan level price adjustments, which are basically kind of like add-ons to pricing and rates for things like second homes, right? Used to be a second home, you could get a similar interest rate as a primary residence.
Right.
And then these sort of high balance loans where, we can look at the new limits. So the way that the limits are sort of structured, they were at like $647,000 a year ago. And the conforming loan limits now nationwide have gone up to $726,200. So you could get a loan with Fannie or Freddie up to that loan amount. Now, in certain areas, like the area where we do a lot of business, which is a kind of the Washington metropolitan area,
right?
Those areas are considered what are called high cost areas, right? And so the high cost areas have these sort of higher loan limits, and those loan limits are 150% higher than the regular limits. So in the DC metro area, you can do what's called a high balance loan, which comes with a little bit of a premium associated with it, as I mentioned before, all the way up to $1,089,000 loan.
Okay.
So you could buy a house for basically, $1.1 million and only put like a 5% down payment today.
Okay, so tell me about what risks are involved for a home buyer in this scenario that's happening. with the
I
raising?
mean, the risk to the home buyer, I mean, I don't think that the industry would characterize it necessarily as a risk. I think there's
Mhm.
always a risk with a home buyer overextending themselves.
Right,
Obviously there's underwriting guidelines in place that help to sort of curb that.
right.
But I think as I've spoken on previous calls that we've had, I believe it's important to really consult with the consumer to say, hey, what are you comfortable paying versus what can I get you qualified for? Because what I can get you qualified for is typically a lot higher than what you're comfortable paying. There's only certain items that are taken into consideration when determining debt to income ratios. So if you have things, additional expenses, like maybe you've got certain daycare expenses, or maybe you have a child in private school,
Right.
or in like I said, like pre-K, those types of things that a consumer would typically have to pay for. Those aren't considered part of your sort of debt to income ratio type items. And typically when one is being qualified, they're being qualified based on the minimum payments that appear on a credit report, right? And
Hmm.
now we know that your minimum payment on your credit card typically is just sort of an interest accrual. So if you're qualifying someone all the way up to the maximum amount, that could put them in
And
sort of a more
right,
in a
risky area.
precarious position. Yeah, yeah.
Yeah.
So
So in layman's terms, people, when they're doing this, they really need to be aware of their costs and really be forthcoming with the information to you as they're applying, talking about what it is that what they're comfortable with and what they're paying for every month.
100%. That's why you need to be having conversations with folks and lenders, whether it be me or someone else, and really kind of walking through a customer's needs, right? Just going online, making an online application, having it sent out to sort of like one of these sort of internet lenders, and they're just kind of plugging in numbers for you and spitting out a rate and spitting
Right.
out an estimate. That I don't believe that gets to I don't believe that necessarily gets the consumer what they're looking for. No less than, no different than you go to see your physician and they just take your blood count and they don't ask you any other questions.
Right.
You can get a good amount of the story from the blood work, but you can't get the whole story. And I think
Right.
the same holds true for, getting a mortgage and buying a home.
Okay, so with these mortgage giants, Freddie and Fannie, raising the loan limits, how do you see, and I don't mean to put you on the spot, but
Sure.
how do you see that affecting the market? I guess more specifically, right here in the greater Washington, D.C., Baltimore area.
Yeah, I mean, I think I don't think it's a deterrent to the market. I mean, I think it's helpful. I think what they use to determine like what they're moving these income or these limits up to is determined on sort of median sales price of homes. There's certain income components to some of the programs that they have, and those are increasing on an annual basis. So, this increase was probably the biggest increase that we've seen in a long time, as far as percentage wise.
Hmm.
Last year it was a pretty decent increase as well, but obviously, as people know, the housing market has gotten a bit more expensive all over the country, not just
Hmm.
sort of specific
Right.
to the Washington metropolitan area.
Right.
Really, like I said, I think it's super important that any consumer looking to buy, has a frank conversation with a lender who's who's well educated and kind of talk through the process. Now we had talked about what are other options out there for folks. There are sort of like these sort of like private buyers of loans, sort of portfolio loans that are out there that many times will play in the space, in the same kind of loan space, where these sort of conforming loans are available. And
Tell me
today,
what you mean by that exactly.
well, what I mean by playing in the same space is in the same loan amount range.
Okay.
Because in the past, many of your investors out there say, hey, we're going to do a loan. And in this case, anything that's over 726,200, we'd be willing to accept,
Got
right?
it.
We're not doing any loans below that limit. And so they're not like competing directly with Fannie and Freddie. Well, what you're starting to see now is some of these sort of private loans. And honestly, I think Fannie and Freddie want to see the private market back into the space so
Uh-huh.
that they're not bearing the burden of every single
Right.
loan that's done out there.
Mhm.
But there's certain adjustable rate mortgage programs and things like that you might see better terms than you would in the agency space. And once again, you want to be talking to a lender that can basically offer all of these
Right.
types of things. But
Explain
like
the
I said,
options. Right. Because
explain the options,
you never
explain
know
the
what will
risks.
fit.
Yeah.
Right.
I mean, a 30-year fixed rate, right? That would be considered sort of the most secure loan that's out there, right?
Right.
A lot of people have sort of shied away from doing adjustable rate mortgages and things like that. But as we've seen just in the last 3 or 4 weeks, some of these inflation readings that are coming out are starting to be positive, meaning, yesterday Chairman Powell came out and said, hey, look, we may not be moving rates quite what we thought we were. Last month, the consumer price index came out and the inflation readings were lower than what they had initially anticipated. And as a result, we saw some improvement, some pretty good improvements in pricing after some really, really bad months. So we are starting to see sort of a little bit of a downturn in rates, like in a positive way.
Yeah.
And hopefully we'll continue to get positive readings on the economy and inflation. And, I've been doing this since 1994. And anytime there's been a recession, we've always seen rates come down. Now, is that for certain that will happen? No, I'm not an economist, but this is sort of my experience and what my experience tells me. So a lot of folks who are doing some of these adjustable rate mortgages and such now, they don't anticipate being in those loans for that 5 or 7 or 10 years. They think there will be an opportunity for a refinance to occur, probably sometime in the next, 12 to 24 months.
Yeah. You touched on so many things, but one of the things that bothers me as a real estate broker, and I only work with home buyers, is a lot of the sensational headlines. I'll read some sensational headline and then I get to the meat of the story and it doesn't quite match what that headline is. So my advice to everyone is, don't just read the headlines, read the meat of a story, and also know I believe we're moving through a period of time that we've never quite experienced, or at least not in any recent memory that I can think of. So it's different, right? But reacting too quickly and reacting to headlines is not a way to navigate this particular situation.
Yeah, I think it's like anything, whether it be investing or buying a house, when there's that herd mentality out there, like you said, people read the headlines and then they freak out. I mean, right now, I believe the housing market has slowed down. A lot of it is because of these headlines. What's really interesting is a year and a half ago, people didn't have a problem, going $100,000 over the list price, waiving every concession, every, contingency that was out there so that they could, buy a house because interest rates were so low. And I get it, why people did that. Well, now interest rates are higher, but houses aren't escalating at that same rate that they were. You have the ability to have an appraisal contingency and a home inspection contingency. So that kind of the pendulum is swinging back towards the borrower a little, the buyer a little bit, which I think is a good thing. And, in the end, this pendulum swings back and forth and you'd like it to sit in the middle somewhere so that, like equal negotiations can be happening back and forth.
Right. That's right.
So, because rates are higher now, that's fine. Maybe you're paying a little bit more and making sure that you can qualify for it in these, first couple of years. But, rates always have the ability to drop and a refinance can occur.
That's right.
One of the programs that a lot of folks are using in lieu of an ARM, you may have heard the term a temporary buy down, right? And a temporary buy down is basically a fixed rate loan. But for the first year or 2 years of that loan, there's a subsidy account that's in place that basically pays the difference between what the note rate is and whatever that year's rate is. So you might have a fixed rate that was at, say, 6.5 or 7%. But if a seller was giving you seller help, you could use some of that seller help to temporarily buy that rate down for a year or 2 years. So that your first year, maybe you're spending that rate at like 4.5%. And then you're going to 5.5%. And then year 3 through 30 is going to be at 6.5%. Now, in that first 2 years, if the opportunity presents itself to refinance, lender comes in, takes that loan out, replaces it with a new loan, and any money that was left over in that buy down subsidy typically will come back to the borrower and can be used towards kind of covering closing costs for a refinance and that sort of thing. But you have to be with a lender who kind of understands that, can
Right.
talk you through it, and give you as a consumer a little bit of, okay, here's our plan. It's not just, okay, let me just get them into a loan and
Right.
let me move on to the next customer. We spend a lot of time talking to our past customers on the best way to sort of like, navigate these waters.
Yeah, just everything that you just covered right there so quickly and so well is exactly why everyone needs to talk to a really qualified, good lender because you got answers. I mean,
Right.
covered a lot in a short amount of time. I told you I didn't have much time, and where you just went right at it. I
Yeah.
appreciate it. Ramez Fahmy with Caliber Home Loans, my go-to guy when I have questions like this about market conditions. Thank you so much for joining me on Listen Up Homebuyers. It really has been a pleasure.
Thank you, Victoria.